Welcome to Biz Wire. I'm Neil Jones in Beijing. The Chinese government recently announced a wide range of reforms following the Third Plenum, many of which are aimed at further opening up the world's second-largest economy. However, according to reports in the state-run China Daily, stock analysts are divided over whether the reforms will lead to 2014 being a bumper year for investors or whether it will be the year when structural weaknesses and underlying problems in the economy can no longer be ignored. A range of optimistic and pessimistic voices were heard at an investment conference organized by Credit Suisse earlier this week. The bank's Asia-Pacific Chief Investment Officer, Fan Chuk Wan, described the reforms announced after the Third Plenum as the deepest and most comprehensive for the past 3 decades. Reforms announced include the opening of the stock market to increase foreign investment, the liberalization of some sectors of the economy, fiscal reform, land reform, and plans to loosen the one-child policy. The government announced that with the exception of some key sectors, it intended to let the market have a decisive role in the allocation of resources across the economy. Fan noted that so far, the stock market had yet to react positively to the reform proposals. However, she said that she believes that the planned reforms would be implemented and would lead to structural transformations and benefit the national economy in the long term. Therefore, she suggested that there was cause for optimism and suggested that investors should consider buying stock in those sectors which the reforms will benefit. Many commentators have said that the announced reforms are lacking in the details which would enable them to make an informed analysis of the precise effects of the reforms. Fan said that she expected more details on the reforms would be released after key meetings such as the Central Economic Work Conference, which is currently underway, and the National People's Congress, which will take place early next year. She predicts that when the details are released, China's stocks, especially those on the Hong Kong stock market, will see a rebound. However, in the short term, the recently announced resumption of initial public offerings, or IPOs, on the mainland is likely to mean that the domestic market will not see a strong rebound. However, not all analysts share this optimism. China Daily reported that Bruce Yam, a strategist at Sun Hung Kai Forex Limited, saw several obstacles to growth in the coming year. The continuing problems of local government debt, the potential risks of shadow banking, and very high rates of overcapacity in several industries may mean that growth is slower than expected. You're watching Biz Wire on the Blue Ocean Network, the first and only privately owned broadcast media. All of our stories can be seen on our website, BONTV/biz-wire. In just a second, we'll continue with more insight into the big picture of China's economy.